Good morning, everybody. This is Dennis Wilburn with the Active Trend Traders. Joining us from Zurich today is Michael Bishop. Mike Traeger is not with us today. And so, Michael, how are you?
I'm fine.
Oh,
Thanks
excellent.
for having me.
And you had a little bit of a holiday. You got off to Malta, and you said you found it a very alluring island.
Yeah, it's underestimated. Also in Europe, it's not that known, but a lot of business going on. Plus, they have nice little beaches, rocky beaches, and I could enjoy a little bit the sun, which I can't currently in Switzerland.
Okay. And so, well, here in California, we had on the coast, we had a big rainstorm come through a couple of days ago, and it was really amazing how much it um, how much rain it dropped in just a very short time. And so, and yeah, Tracy, we will run quickly, and we'll be able to look at Facebook for you. And so I want to remind everybody that all the materials we present are for training purposes only, and that you should always paper trade any new method prior to the risk of your own personal capital. I really hit on paper trading, and that's one of the things that I really like about the Thinkorswim platform from Ameritrade, TD Ameritrade, is it allows you to have a standalone paper account that trades. Basically, you have to put in orders, you have to do the same kind of thing with that you do with a regular, and so it's really a good practice vehicle. And if and again, I am not well, other than I just like the system, but I get nothing from TD Ameritrade or anything like that when I talk about it. But if you are, looking at a new platform or TD Ameritrade, and you want to open an account with them, when you call their brokers first, or go see somebody at TD Ameritrade office, and basically have them offer you a deal to bring your dollars over. Depending on the size of your account, they have cash incentives, and they also offer free trades, and also you can negotiate the commission rate, which is something that I really like. So here, that was my disclaimer. Here's Michael's disclaimer from his European disclaimer. You can go back and review that.
Yeah, my homepage was down some days, and I rearranged or I will rearrange a lot of things, and so I did not got out with any newsletter or so, and so I think no participants on my side today.
Okay. And so, with the active trend trading, guys, I am very much about helping people learn how to maneuver, and especially in markets like we're having right now, how to get around in them, how to do well. And one of the things we do with the Active Trend Trader Premium members is that we do a midweek market sanity check training session. This coming week, we're going to be talking about, on February 23rd, we'll be talking about reversion to the mean and finding the turning points in the market. This is really good. Mike Traeger has spent a lot of time looking at reversions to the mean, and we chat about it quite often. We chat about this quite often, and it is a very predictive. It doesn't necessarily pinpoint the exact bottoms, but when you start getting stretched away from the moving averages, which are the mean, there tends to be it tends to set up for a potential turnaround in the short term. And so, because things like to go back to the mean. David asked, how did Michael and I get to know each other? Basically, it was online. Michael sent me, his resume of what he's done over there in Europe, and we thought it would be a good match, just to basically give kind of a European flavor to what's going on in the market. And so I invited him to just, to comment as we go through our process. This week, we're in a relief rally that has hit resistance. Now, what next? when we get to the charts, I'll be chatting about specifically about how we've hit resistance, but we haven't went into a major sell-off, so I find that kind of interesting. So the S&P seems to be stuck in a range. Longer-term charts still favor the downside, but if we go back and look at a similar time period, I really believe that that what we're going through right now is very similar to what happened back in 2007, 2008 timeframe, and from the late January, early February through about May, the market actually went, the S&P actually went on a little tear and actually was up about somewhere between about 14%. The NASDAQ was up about 20% until it reached its, ran out of gas again and then went into the significant downside in May, moving down. So that's why I basically indicate here where it seems to be, the downside seems to be the favored side, but we may be going into just a little bit of a sideways for could last for several weeks and or months. That would drive prices back up, and so and also increase the choppiness of the market. I know that nobody wants to hear the market's going to stay choppy, but it's looking like volatility is going to be around with us for a while at least. NASDAQ 100 relief rally. That may last for several weeks. That's what we're in the process of. Kind of interesting today. The markets are mixed. The NASDAQ is up as of this particular point in time, and then the S&P is in fact down. The Russell the Russell is also up a little bit, and really Russell relief rally. Outside influences affecting this week. Of course, this morning the nation's CPI was reported. It came in a little bit stronger than normal, and the Fed heads were out there chatting about, well, that's just proof that we need to go ahead, we need to push ahead with the interest rate increases, but then other Fed heads were saying, no, we have to be accommodative, and so there appears to be some confusion at the Fed. But the outside influence are similar to what they were last week. A little bit of earnings. All the big boys have reported earnings, but oil, some of the oil producers trying to strike a deal like Russia and Saudi Arabia to limit output, but that does not necessarily take away the glut that's on the market right now. The supply is still huge. U.S. economy. Global economy is issue, and then the Fed, FLAC, they have been criticized for raising rates, and we'll see if they back off and let rates just kind of sit for a while, because all the reasons why they, who knows, 2020 hindsight, 100 years from now, Michael, we may say, oh, the Fed was so smart in what they did, and Janet Yellen was just so brilliant. But that's probably going to be about 20 or 30 years down the road when we see the longer term effect of the decisions they made. We are still in what I call a hit and run trading environment where getting in, taking a little bit of profit, and then jumping out is, while not desirable for somebody who is working full time, it is what the market is giving us right now. And so, Michael, you were saying that you were trading some options and doing a little bit of quick hitters yourself, correct?
Well, my current kind of core strategy is selling premium. So I don't want to have a strong bias, a slight bias to the downside.
Yeah.
And collect premium, because that's now really wonderful that you can, if you are a little bit wrong, you can still make money.
Yeah. And so,
or in other words, I would even say if you're not completely wrong, then you can make a little bit money.
Yeah. And so one of our members just asked a question. She's selling covered calls and trying to go with a premium that's weekly premium is 70%, probability of being expiring out of the money, excuse me, and the premium is very little. You know, and deep, it's going to all depend on how early in the week you sell next week. So that's why I like Thursday and Friday, because then you get to melt that premium away over the weekend. But secondly, if and the other way I like to do my weekly covered calls or my weekly strangles and spreads is on weekly options, is to, you know, plan them in the direction of the trend, and you hope like heck that they work out, and have, you know, have specific stop losses in place. What amount of premium is acceptable for a 70% out of the money probability? You're probably going to pick up maybe somewhere between, you know, about, you know, 0.5 to 1.25%. Maybe if you're lucky, you'll pick up 1.5% of the value of the underlying. Hope that helps a little bit. And all the non-option traders are going, huh, what did he say? So here we are on the percentage of stocks above the 20-day moving average. This was from last week, and as you see, we were coming up off a bottom, and here we are today. We came up and peaked up here right about the 65 level. Bearish engulfing pattern on yesterday's move, and then we're dropping down a little bit today. There is a really cool, if you have an opportunity to watch the intraday and watch the daily charts today, there is a really great battle going on between the buyers and sellers. I know that a lot of the institutions had said that they were going to basically lighten their positions as the market moved up into, you know, into relief rallies. But the majority of them are probably in balance for where they want to be, and I think what that is reflecting in what we're seeing in this, you know, what's happened with, you know, the sell-off started yesterday, but it was very muted, very, very muted, and so we shall see. We are back up here in a resistance zone. And so are the percentage of the stocks that have moved above their 20-day moving average? It's sitting up here about 58 as of this morning, or 58.38. Is that going to push us back up into the 75 or 80 level, where you normally get a potential reversal, or it's showing strength in the market? That's where a little bit of judgment on this chart comes into play. Is it just that there were so many stocks that were just hammered down, and even below, you know, we're going to go to the percentage of stocks on the NYSE that are above their 200-day moving average, but the stocks were hammered down so much that in reality, you know, this 20-day moving average is much like, if here's the 200, this 20-day moving average is down here, way down below this area. It is way extended, and so we're getting these little bounce ups, and we'll see, you know, whether or not they're going to hold or not. And so it appears the trend line has been broken from the tops. What does this mean? And Eric, I think I just indicated that's what that means, is that stocks have gotten so beaten down that the bounce up and the 8 and the 20-day moving average have gotten so far removed from the 200. That's what we're seeing right now. Is it's a much easier target for them to get back above the 20. Will it strengthen up and continue to go higher? We shall see. Or was yesterday's, you know, showing us where the high is for the next turn down? And that's where I said. Yeah, go ahead, Mike.
The earnings season is almost over.
Yes.
Will that affect the kind of stronginess of the movement?
You know, that's a great question. I do not, because earnings season has been where basically the stocks have either been rewarded nicely or beat up. significant, severely. I don't think earnings are going to do that much for it, but one of the things that's quite interesting is within the earnings, stocks that have popped above their 20. However, they're still in a major downtrend because they're below their 200. So that could be an indicator on that particular chart. Last, here's the percentage of stocks above their 200-day moving average, and we actually, some of the stocks did move up. The stocks have been basing for a while, moved up. We've jumped up to the 21.36 level. However, it is still down in this lower reversal area where you would expect either to come up here, hit the 30, drop. Longer term, if the bias of the market is going to continue down, then we're probably going to get back down here and visit the 10, somewhere between 0 and 10, 5% of the stocks above their 200-day moving average. We have had a little bounce up, and we can see the comparison chart that I have up here is the IWM, which is the proxy for the Russell, and it actually bounced up a little bit. It was sitting down here, below 100 last week. It's come up to just a little bit above 100. This is a monthly line chart that measures the whatever the number is for that particular day. So that's kind of interesting. Are we going to, in fact, is this a bottom, and how strong of a bottom will it be? So as of 9 o'clock this morning, here's where the markets were approximately. And as you can see, yep, they have come up a little bit from last week, somewhere between 2 and 3%. Up for the week. They are basically still off their highs. The Russell is still in what would be considered bear territory. And we're going to be looking at the charts. And I like this. I don't know if you guys have seen this photo. I just imported it. This is a view of Earth from the Hubble telescope. At least that was the caption on, and I thought that is really cool. And I think it kind of provides a kind of a current, a good current picture of what the market's going through right now. There's a few, breaks in the cloud where the sunshine's coming through, but when I was flying, one of my first instructors took me outside and showed me on a cloudy day, and there were these holes in the cloud cover, and he said, those are called sucker holes. He goes, they'll try to sucker you into taking off and fly, and flying. We were flying under visual flight rules, taking off, going through that hole, and then as soon as you go through that hole, it seals up, and then you can't come back and land because you would not be able to maintain visual. And so I don't know, maybe globally, are we potentially seeing some sucker holes? I don't know, but I thought that was a really great photo. So let's go over and look at some charts. Okay, S&P. S&P basically bounced I think it was last Thursday or Wednesday, came up of support, and I want to highlight to everybody this, and I was sharing with Michael a little bit earlier, about 4 or 5 years ago, I think it was in basically back in 2008 when the market was recovering, is you had this. There you go. The market went into a sideways trend, and it was a significant sideways trend because the from top to bottom was about 10 to 15%, and as you can see on this one, it's about, well, no, it was about 7 to 8%, but on the leverage index ETFs, you're looking at 15 to 20% move between the high and the low. And so like on this one, we're about 7% on the S&P. And it appears as if we've come close to this resistance back up here at 1950 about. We're inside the fib retracement box, which is a fib retracement from this high to this low. and we have gotten back up there, and we're finding what you would expect. We're finding resistance. The big question I have going into this weekend will be, are these candlesticks, are these price action from both yesterday and today, are they stalling, indications of stalling, or are they indications that price action is going to basically just stop right here for a little bit, maybe bounce on up here to the 1950 level and then roll over? And time will tell. At this point, we do not know. A couple of things on the daily chart. It appears as if the true strength indicator is trying to turn over, and as you can see, the momentum actually dropped down a little bit today and became negative again. And oftentimes in a sideways market, what you'll find is the momentum just basically jiggle-jaggles around that zero line, such as what we saw back here and also here. And you really know, for several days and or weeks, you don't get a lot of really strong upside or downside or trending type moves. We see the same thing on the weekly chart over here when we were going sideways for most of last year. The momentum indicator was just saying there's not a lot of momentum there. And it wasn't until we got some really blowouts to the downside that we finally got some momentum back up to the upside, but then it reversed, and we are currently just sitting down here. That's taking away from the argument that the market wants to drive a lot higher. This week we bounced up, we hit against the 8-week moving average. And so right now, while we are not selling off real hard, the 8-day moving average reacted the same way it did 2 weeks ago when price actions got up close to it and then reversed. And we'll see what transpires today. If today's close on the S&P gets in the lower part of this candle here, lower half, then it's a potential that, yes, while we do have some support at the moving averages coming up, that this is just merely a moving average squeeze and a break down below this level, which I'll say we're probably going to go back down and retest either at the 1867 level. If that breaks, then watch out for this level here. And then if that gets down here, then that, after testing 2 different times, that would be a very good opportunity to try to get long on a leverage index ETF, or even the SPDR index ETF. And so very interesting what's transpiring here. I want to basically go back in time a little bit though while we're here on. The question is, do you think it won't tank at the 1800 level? That's a great question. I know if we break this 1812 level, there's a, 1812 to 1800 is a resistance support zone. If it breaks that, we're probably going to stair step down 1750, 1700, and we could revisit. Matter of fact, if you measure from here down to here, and if this level breaks, that'll give you your projecting going down. And it goes way past this 1577, which is the high from 2007. I want to go back in time just a little bit to, there we go. I think this is where I want to be. No, here's where I want to be. This area here, and I'm going to blow this up a little bit. Okay, this area here that I'm looking at, and it's highlighted down here on the TSI, is the period from 2008, January, and this is a weekly chart, January through, I want to say this is the first part of May, where it finally turned back over. But it took several weeks after coming down and hitting its new low, or hitting a similar low, It went 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks until it finally, the weight of the market finally caught up with it, and then it fell back the other way. I think that we are in a very similar type situation that we could see work out in a very similar way, where prices do, retest a little bit, but we've got it in kind of a short-term uptrend, but the short-term uptrend lasted for multiple weeks before it finally gave way and then dropped, came back up and tested again, and then went on its final plunge from, and this was about September of 2008, where it just dropped out of the sky. And so kind of an interesting perspective there. Very, very, like I said, very, very similar to what we've got going on. There we go, get that highlight. What I see going on with the charts right now. Okay, let's go over here to NASDAQ. Michael, have you been doing any comparison back to 2007, 2008 time frame?
Not really, no.
Okay.
Thank you. No. I mean, what I have noticed is that there are some kind of boring high quality stocks that have already been traded in a range in the last 2 years.
Yes. Yeah. And so, and Deepa says, but we don't have the housing mortgage meltdown of 2008. That's true, Deepa, but at the same time, we do have other bubbles that are, and one of them is just the financial bubble that's going on. And a big difference between now and 2008, the Fed has, and all the banks around the world have fewer bullets in their gun to be able to solve situations, because back then they were able to, cut the brakes multiple times. They pumped up with the QE program, and I mean, they may make it a choice and say, you know what we're going to do? We are going to, go back into a QE situation, increase the debt and all that kind of stuff. But eventually, that's one thing they're talking about right now is just the debt bubble. In the U.S., consumers, while they have been paying down their debt, they're still at a very high level of debt historically, and the government, we know, is in a huge level of debt. So, like I said, there are fewer bullets to be able to attack, if everything does continue to go sideways. So, what do we got going on the NASDAQ?
It is plus the bond market that I would say has gone crazy. I mean, it comes from Europe, but I think it's in the US. The situation is comparable. I mean, why the hell would you buy bonds when you get basically no interest on them? Yeah. Plus, interest rates can only go up.
Yeah.
Because if we have for a longer time people and institutions get creative, I think it can't be sustainable.
Yeah, and one of the things we don't want to forget about is for a long time that when the Fed made, basically reduced interest rates to zero, a lot of the banks out there did in fact borrow money, but they didn't pass it on to the consumer. They maintained it themselves, and a lot of companies, some of the companies borrowed money because it was so cheap, and then they in turn turned around and bought their own stock and did stock buybacks and all that kind of stuff. And so when that starts to, that is evaporating now. And so it's kind of interesting is a lot of the upside of the market has been propped up by the companies buying their own stock. Matter of fact, they and not spending on things, and we've hit on this previously, and not spending their money on things like R&D and all that kind of stuff to be able to provide a better product. Yes, they are showing that they're more efficient because they've done a lot of downsides and all kind of stuff, and it makes them look real healthy when they're buying their own stock back, driving up the price, but at the same time, eventually, that's part of the other bubbles that I'm talking about. So let's go here to NASDAQ real quick. NASDAQ yesterday puts in a dark cloud reversal candle, and as long as the top of that dark cloud stays in place, and this is a reversal candle showing us that we should proceed to go down. Now, of course, we have to push back down through the 20 and through the 8, and also this level at about 4,100. And see how far we retrace back into here. You can always throw on a fib retracement, which I think is always whenever you have a solid swing high, swing low, throw on a fib, and I'll give you an idea of where potentially we could retrace. If prices get back down here into the magic fib box, 61.8 to 38.2, that is the 1/3 to 2/3 pullbacks that even Charles Dow talked about, noticing that stocks would do when they were basically in and doing some trending. And that's where we would watch it. If it fails there, how much further down it's going to go? Are we going to retest back up here at 4,200 and then flip over? At this point, we don't know for sure, but as you can see, the downtrend that is showing on the weekly chart, where the 8 has crossed below the 20, which is crossed below the 40, is still in effect, acted as good resistance going into this week. And now we're seeing where price is going to stabilize today. Today is kind of a little bit of could be a false indicator for us, because today is monthly option expiration day, and on monthly option expiration there is a bias for the market to be up. And so as you can say, as I said earlier, there's a interesting battle going on between the buyers and sellers, where some of the buyers want to push prices to certain levels because they have options that are hanging out there that are worth, for some of the bigger institutions, billions of dollars. Russell. And we can see here on the weekly chart of the Russell, we've got a nice up week. However, momentum is down. We are getting some, and here's part of the other positives that are shown, like on the Russell and the other indexes, is we are looking like the TSI is trying to bottom. So let's see if we get a little bit of a higher low, some good positive divergence. If prices do reverse, pull back down a little bit, and then pop higher. And as we can see, we have moved right back up on a daily chart, as more shows more, right back up into a resistance zone where prices have gotten clogged up, and we may be at a place where it's putting in a lower high, and then we'll see what transpires through the rest of the day on where prices are going to go. So kind of an interesting perspective. Positives here are, of course, coming off the bottom here, we had some good positive divergence on the momentum on the TSI, but now we're getting back up into that zone where if the downtrend is going to continue, where price action potentially will turn back over. It is holding support though at the moving averages. The 8 is on its way up. It is holding support at the 20, just barely. So that's what I see going on in the market. We're still getting some really big swings. Good hammer last week, moving back up towards strong resistance, and we'll see if we get some stalling going into next week or just a complete reversal. So anyway, do you see a divergence between the NASDAQ and S&P down and the Russell /up? Pierre, that's a great question. Oftentimes, of course, the Russell has been the weakest of the indices, and you can tell that because it is so much further away from its moving averages. So, if it was to revert back to the moving average, it would have a further distance to go. As of over the last couple of weeks, the S&P has actually been the strongest of the indexes, and so primarily the S&P and the NASDAQ tend to trade places back and forth of which one's going to be the leader, which one's not going to be the leader. And I try to recognize that on the chart, but don't build a lot of basically, if I build anything on them, on the fact that one is diverging from the other, like if the S&P or the Russell was, in a huge downtrend, which it was earlier, what happened? Well, it rather than the other two indexes raising the Russell, they actually fell into line with it. And so I look at, when we're getting a mixed market. If the NASDAQ finishes today up significantly and the S&P and the Russell turn out to be down for the day, or if the Russell and the NASDAQ are up, the S&P is down, I'll look at that. Is things just coming back into balance, or are those other indexes, the buyers of those stocks into the indexes, are they deciding, okay, hey, we're going to, catch back up with what the S&P has been doing, and it just kind of ebb and flow. And so, do you have situations? Let me ask Michael. I know, Michael, you track the European markets. Do you ever look for divergences between, like the German market, the British market, and the French market?
Well, I mean, it's relative. I mean, you have on the one side, so all you could say, if you take the solid countries like Germany, Switzerland, and the UK, then the correlation to the US is very high.
You're right.
And for the weak countries like Spain, Portugal, Italy, they tend more to behave like Brazil, Argentina, and emerging markets more and more. So or in other words, they also are highly correlated. Basically, they have, I would say, bigger beta. That's all.
Okay. And so, so it's like you said. Does it tend to be that the German market is the German economy is the leading economy in Europe, and they're basically, that's where the strength comes from?
Yeah, definitely.
Okay.
But on the other side, Germany has very strong industrial titles.
Right.
I mean, Mercedes or Daimler and BMW, also the premium car manufacturers, BASF, also some strong chemical companies. That's really what drives the German market.
Gotcha.
And the Swiss market is pharmaceuticals plus Nestle, you could say, a little bit finance.
Right.
And the UK is, I'm not so familiar with the index, but what I know is that it's it's more to the finance side.
Okay.
And this explains also most of the movements. I mean, as a consequence, Germany is more related, or if China has a problem, Germany has a problem too, because I mean, China is I think now the biggest market um, in in cars. I think so.
Okay.
And yeah, you see this. And Switzerland is more a defensive market. But as I said, or I'm saying, since the last year, because there was a lot of hope that Draghi and the quantitative easing in Europe that came later, but is now also quite strong, that it's too late and doesn't save the markets. Or
Yeah.
if you look to the chart, there are no hideaways in Europe.
Okay.
You lose exactly the same, if not more, than in the SPDR or IWM or QQQ.
Okay. Well, thanks, Mike. Path of least resistance going into next week. Folks, I think well, like I said, the market is kind of like at a little bit of an equilibrium point, and that's why we're having this battle between the sellers over here and the buyers over here, and they're fighting back and forth. And so we'll find out, which way, are the bears going to come back up and rise up and eat up the bulls? Or are the bulls going to kind of keep it at bay, or is it going to turn to where it's just basically an even keel for the next little bit? I'm looking to trade this market basically between support and resistance. Right now we're in no man's land between both. We have to go with the ultimate, the trend still is down, and so I think there is a bias this way, although we may get a short-term uptrend that lasts for several weeks and or months, but if the prices, the character of this current market does continue to emulate the character of the market back in 2008. So had a little bit of bumpy ride this week, but we basically are still setting up a little bit over $2,000. This is profits that have been cleared from the account for the week, or for the where our bump came was in our strategy 3. As the market rebounded, we did take a couple of hits on our strategy 3, but still, as far as overall on what has been cleared, it's still up for the year, and cumulative is about 2.6%, and the equity curve has been adjusted to be more reflective of what's going on. Or actually, I adjust this every Friday. And so at the end of next Friday, of course, it will be the end of February, and we'll see where we wind up the month of February. Future presentations, for those of you in the Bay Area, we do a monthly presentation and training session at the Bay Area Moneymakers meeting in San Jose. I'm in the process of updating training videos to make them a little bit more effective and efficient for people to review and study. Since this is becoming more of a hit and run type market, stand by. If you're a premium member, you're going to start getting more alerts on Tesla, things like Tesla, Netflix, Amazon, and what I call the big moving stocks, and because they do jump around a lot. I mean, the average true range on some of these Tesla is about, sometimes $10 a day. Amazon, same thing. And so I am coming up with I'll be doing a presentation on the midweek market sanity check in a couple of weeks about how to trade these, utilize the active trend trading system, but how to trade these individual stocks, in the shorter term. And so if you have a group, I would love to present to your group either in person or via webinar. I really enjoy doing that. So, if you want to, sponsor a group, and then we can come in as a webinar, or I will come and visit in person if you're in the Bay Area, the San Francisco Bay Area. Active trend trading system. I'm continue to try to clarify, simplify, multiply. That's our basically our motto. We follow the 5 pillars of the active trend trading system, which is what to trade, when to enter with an entry point, and we define what those are, when to exit, we define where we're getting out, what strategy we're using, and what to expect. All of our strategies are based off of the foundation of the active trend trading system. So if you watch a recording or you're not a premium member or an early wording alerts member, you can join at a significant discount if you're taking the time to watch this video. So I want to say thank you very much. So we want to say, Michael, see you next week, and see everybody else next week. If you would like to, hey, I'd really appreciate it if you just kind of like let your friends know, say, hey, watch this video, it comes on, or watch the video come live or whatever. And if you know people who are interested in what's going on in the market. So with that, I'll just say, trade wisely, trade profitably. And I'm going to look at a couple of stocks. So God bless everybody. Have a great weekend. So what stocks do we want to look at? Twitter.
What are it's not a stock, but an ETF. I mean, TLT and XLU are for me the most ridiculous charts. Yeah?
Okay. Well, I promised Tracy we would take a look at Facebook to get that recorded. And what we see going on with Facebook is it is also kind of, like the markets, it looks like it's stuck in a trading range. Now, this has a pretty large trading range, but what I'll do is I'll just come here to the top of these candles on a weekly chart, because we know we had a close and an open on that. That shows us that's where the strongest piece of support was. Same thing down here. You've got a couple of support levels, one where the candlestick closed, approximately there, about 95, and then also down here at the 90 level. This looks on Facebook like a low volume wedge up, and if this breaks this trend line to the downside, Facebook looks like it will drop back down into this area here. Because remember, we had a failed breakout on higher volume, and it's trying to do something constructive here, get back above the moving averages, but it's really struggling when it's come back into that resistance area at about 105. So that's what I'm looking at there. Plus the momentum on the weekly chart has gotten kind of soft. And then our TSI is going sideways right now. Momentum down, volume down, and sideways. So, 105 back down to the 96 level. So you got about a $9 range there. So let's see what we got here. Michael, what did you want?
Just TLT for a little.
Now, see, TLT is the
it's the 30 years bonds market.
Yeah. Now, is this one leveraged at all?
I mean, who would have thought that after a raise in interest rates, bonds go straight up instead of down?
Yeah. And
it doesn't make sense. I mean, it's only because people don't want to lose the money in stocks, so they shift it to bonds.
Now, is TNT the? No, it's not. What's the flip side of that? TLT and
TBT.
Yeah, that's right. Okay.
But that's leveraged.
That's the inverse, correct?
Yeah.
Yeah, that's the inverse, ultra short.
But double leverage.
And TLT. So what other one did you want to take a real quick pick at? So, okay.
Well, XLU is kind of seen as a proxy to to TLT. That's the utilities.
Yeah, and that's what, what's really interesting. And it's got some pretty good moves, but you got to look at the range and the magnitude of the move. From here to here is about a 12% move on a weekly chart. This is the first index ETF that came on to IBD's leaderboard and still on the leaderboard. And so I think that kind of gives a peek at the specific health of the market, if you will, when the utilities ETF has made it onto the leaderboard. It's telling us that there's not a lot of strength out there.
Yeah.
So let's take a look at Twitter.
Coming back, Twitter.
Okay, Tamsin, Twitter is. Are you trying to bottom fish? And I say that because it's been a significant downtrend. It has been, maybe it hasn't been going on that far. Why do I not have? Hold on a second.
Well, I think Twitter is a disaster, but it has gone so much down that I think sooner or later they will make a significant change, or maybe Facebook will buy them or whoever, and then there will be a quick, very strong rebound.
Yeah, but then it will die out.
No, I think Twitter has just the user base is more worth, or there must be capable management making a profit from this.
What I meant by dying out, if somebody makes an offer for Twitter to buy it, it will probably rebound to a certain price, the offer price, but then it will go sideways from there. It'll go sideways from there. And Tamsin, for a potential dead cat bounce, it's looking very positive, but how far is it going to go? Even if it only runs back up to the 8-day moving average, well, you're actually talking about 15 to 20%. If it moves back into the bottom part of this resistance here, you're talking about 13%. What would be kind of fun, which I always like to see, is kind of something like that, and then a go. And so this may push up, and this is multiple sides down, but so we'll need to see what happens when it gets up in this area. But if we get a retest down in here, that's where I would be looking at, or a bounce up and then come back and a retest to the 8 and a takeoff from there, because we're getting some pretty good volume. But I would, if I would keep this on a watch list and watch it, because on the daily chart over here, it's looking like it's kind of reaching the peak of this initial move and needs to come back and do some consolidation and pull back. Let's see what else we got. We have Ellie. And Eric, this answers your question that you sent me the email on Ellie. Get this back to here. Okay, Ellie. Ellie's in the okay, a couple of things that I like about Ellie, a couple of things that I don't like about Ellie. One is, we can't, this is all due to earnings, great buying volume here, but it's brought us right up into a resistance zone up here at the 82 to 83 level. Now, so that's all positive. One of the things that I'm kind of leery with Ellie about is this has been a very sharp uptick, and so we've run into resistance, and we need to see either some basing, some consolidation, because if we break out immediately above this $83 level and it goes exponentially up from there, that's a sign of a very weak uptrend, because these straight up off the bottom moves, like it went from 58 to 82, in just a few days, and I recognize that, yeah, part of that is due to earnings. Well, it needs to digest in this area here. And so this is where we may see, and Ellie is still interesting to me, we may see this pullback. There's a cup. We see a little bit of a handle pullback. I'd be looking for this retest back here at the 75 level, because if you pick it up at 75, then even a rebound back up to 82 or 83, that would be a nice little move up. So that's what I would be looking at on Ellie right now. MS. Because you can see as it gets higher, it's basically easing off on its upside. Got MS. Again, really rapid move. Okay, high velocity move up off the downside. It's going to run out of gas probably around the 72 level. And if you get some bouncing around between, I'll show you, pick this low here or high here. You may get a little up, pull back towards this area. I would draw a support line in there. You get around that, that would be the potential place where it could bounce from there, Richard. Yeah, fairly, that's not positive divergence there. Slightly above average volume on this move up. So there weren't all, you know, while yes, this is above average here on the daily basis, it was not hugely above average. So good looking chart though. But as you can see, it is away from the mean. And so it's getting to that place where it's going to be extended. And this is where I keep, I'll just show you guys, this particular envelope is on a daily chart is 10% above the 20-day EMA. And as you can see, the last time it reached up to that point, it did do a pullback, but several day pullback back to the moving averages and then a rebound from there. And so we are extended, it's about 7 to 8%, but if we get extended up there in the 9 to 10% level above the moving average, that's where we're, you know, we could expect a pullback anytime between here and there. LE, HS. Okay, here's the kind of moves we've been, I'm glad you brought this one up. Who brought this one up? Eric, yeah. This is the kind of moves that we've been talking about that have basically swung that percentage of stocks on the NYSE back, you know, above their 20-day moving average. What has tipped the scale there? And on this one is what we're seeing here, is you're getting these gap ups with earnings that are breaking things out above their 20-day moving average. However, they're still below their 200 and their 100-day moving averages. And what is happening is, as you see here with AHS, is they're getting right into a resistance zone and then stopping on the majority of them. So it may need to do a little bit of more consolidation here. That up move is a, you know, nice volume on it for, you know, reaction to yesterday's earnings. But it is, you know, it's seeking where it's going to stabilize at. It has not, at this particular point, pushed past. It has not, at this particular point, pushed past and closed above this level of resistance. So that's where we want to keep our eye peeled. And if it bounces around here or falls back down, and in volume increases, that's telling us that basically that this was just simply an earnings reaction and the underlying weakness in the stock will continue. Another one that is very interesting to me that I'm keeping an eye on is XRS. but it too is up here putting in these spinning tops and dojis, which are candlesticks of indecision. Look at what we got going on here. We've got negative divergence, and so XRS, which has already done earnings, could be setting up for a potential fail. And if we do drop back down to this level here, which would not be surprising, back down to this strong support level here, that is about a 14% drop. So, okay, guys, I think I've hit everything. We are at the end of our time. Michael, thanks for joining us today. Folks, have a really, really great weekend, no matter where you are. And we'll chat with you next week. If you have any questions, just don't hesitate to email me.